Hi, welcome to Bookie. Today we will unlock for you the book The Big Short. Speaking of the US subprime crisis, we believe you are already familiar with it. The crisis began in the spring of 2006. At the time, many Americans that borrowed money to buy homes couldn't afford their bank loans. They sold their homes and housing prices plunged, which triggered an economic crisis that engulfed the housing and financial markets. By August 2007, the crisis had influenced the financial markets of the US, the European Union, and Japan. It also brought unimaginable damage to the famed Wall Street. However, some saw the crisis well before the bubble burst. While everyone else was dreaming of making money, they shorted the market and made handsome profits and became one of the few people to make a fortune during a financial disaster. They performed what the book calls the Big Short. So, who are they? How did they manage to see the situation clearly? That is the story of The Big Short. The book was written by American best-selling author Michael Lewis. His best-selling books include Liar's Poker, The New Thing, and The Big Short. Forbes chose both Liar's Poker and The New Thing as the 20 most influential business books of the 20th century. He is currently a contributing editor of Vanity Fair. In The Big Short, Michael Lewis' ability to capture the ins and outs of financial trading and the way people think and behave has a lot to do with his own experience. In his early years at Wall Street's top investment bank Salomon Brothers, he gained deep insight into the financial industry. As soon as it was published, The Big Short became the go-to book for people who wanted to study the financial crisis of 2008. In 2015, the book was adapted into a film that won the Oscars for Best Adapted Screenplay. While the film focuses more on Wall Street's greed, what we're going to unlock focuses more on what caused the financial crisis and how people responded to it. Next, we will explain the core content of the book from 3 aspects. Part 1, What caused the US subprime crisis? Part 2, The truth behind the bubble and why people were so optimistic? Part 3, Who benefited from the financial disaster after the bubble burst? Part 1, What caused the US subprime crisis? We mentioned earlier that the US subprime mortgage crisis triggered the 2008 global financial crisis. So, what is subprime? This is a financial term. The full name is subprime mortgage, which refers to loans made by lenders to people with poor credit and low incomes. It is different from a prime loan. The so-called prime loan refers to returning what has been borrowed on time. The case for subprime is not the same. For example, let's say a man named Tom just started working and has a very low income. If he wants to buy a house, he has to borrow money from a bank. If the bank lends to Tom, there is a risk that he may not pay back the loan. This kind of loan is called a subprime loan. The American subprime crisis began when banks lent money to many poor people to buy homes. At this point, you might want to ask, would a bank lend money to someone who can't pay it back? The answer is yes, and that was the intention of the US government. When it comes to buying a home, we have to go back even further. From the late 1980s to the early 1990s, the United States real estate market continued to boom for more than a decade. The number of home sales continued to hit record highs, and housing prices also increased at a rate higher than 10% a year. American housing prices doubled in the 11 years between 1995 and 2006. In addition to the housing market, let's look at the US economy at that time. From 2000 to 2001, the US economy began to decline, and the rate of decline accelerated after 9/11. The Federal Reserve Chairman at the time, Alan Greenspan, adopted a series of measures to stimulate consumption. One of these measures was to cut interest rates. At that time, deposit and loan interest rates in the United States were very low. It even got to the point that the interest rate reached 1%. If you put $100 in the bank and withdrew it at the end of the year, you would only get $101. In contrast, America's housing market was booming. If you borrowed money from a bank to buy a house, the housing prices could rise by more than 10% in a year. The interest you had to pay to the bank was negligible by comparison.